Well, good evening and welcome to this live stream on the 1st of October 2024. Will soon be Christmas. It's Martin North here from Digital Finance Analytics. Thank you very much for taking some time out of your Tuesday evening to share it with us. Going to have a really interesting conversation with Damien this evening about all things market related. A lot to talk about: liquidity, China, what the Fed did, what Australia isn't doing, all those things. So it should be fun. Before I bring him in, let me just remind you, I'm not providing financial or legal advice. This is a general conversation only on this channel. Please play nice in the chat room. We do moderate the chat. This is as at the 1 October 24. If you're watching in replay, if you'd like to ask a question, then please use that Walk the World in your question. That'll get it into my question queue so I don't lose it. What happens is the chat gets very busy and then I don't necessarily see all the questions. And finally, enable Super Chat. And if you want to get your question top of the list, you can use Super Chat to do that, or indeed make a contribution to what we do around here. We do this not for profit because we think this is a really important conversation, but we do really appreciate the support via the Super Chat because it really makes a difference to us being able to make these shows. Right, with that done, let me bring Damien in. Damien, hello, welcome back. Another month gone by.
Yes, another exciting one in the books.
Who'd have thunk it by the end of the month? With September and October generally are the most wobbly times in the year. And of course, at the front of September, we had some wobbles. But second half of September, thanks to the Fed, thanks to China, things have gone very different now. And I just want to put this slide up just to sort of, people may not have seen this. This is actually what happened to the Shanghai index. Massive rocket, as you can see there. By the way, it's still relatively down from 2021. So the fact of the matter is, China did some stuff, but there's also some broader questions too, I think, about liquidity in the system, equity valuations, price earnings ratios. Oh, there's so much to sort of wrestle with. So where do you want to start the conversation, Damien?
Let's start with China, because it is having a huge difference to the Aussie stock market, and particularly iron ore stocks, which is sort of interesting in that it hasn't really affected South American stocks, which a lot of copper and sort of other metals that sort of go into the production process as well. And so there's a number of disconnects that I guess I'm sort of trying to work out. Is this a sign of more? Because there's been the argument all along. Every time we see a bit of stimulus coming out of China, over the last sort of 18 months or 2 years or whatever, it's all been very incremental, and it's all been a lot of words and a lot of re-announcements. Like there's been a number of announcements that have just been rehashed time and time again. It's like, oh, there's this new announcement about China doing whatever. And it's like, actually, that sounds awfully like the last one. And it's like, oh, yes, it is. It's the same one. They're just re-announcing it. And so the question is this the start of the whatever it takes moment? Is this the part where China's just said, you know what, it's all gone too far. We've got to bail out our property sector, and we're going to do whatever it takes to get the property market going again. That might happen. It certainly hasn't happened yet. Like the announcements to date are still, there's a number of rehashes, but it's still all monetary stuff. It's still about saying we're cutting interest rates. We're going to fix this problem with lower interest rates. We're going to lend more money to the developers because to finish existing projects. We're going to cut reserve ratios. We're going to it's all about this idea about we're going to give all this extra money to our to the local governments. And that's what's going to solve the problem. And it's sort of like this argument we've been saying for a long time. They're pushing on a string. They're at this stage where it's not liquidity. It's the fact that they've built too many houses and they haven't sold them. And you've got too much debt. And so by offering people more debt and offering these companies more debt, you're not going to spark the boom again. So there's two parts to it. One is, can they arrest the house price fall? And maybe they can, maybe they can't. I don't know. It doesn't seem as if they've done enough to do it to me. They're going to have to keep going if they want to arrest the house price falls. Can they get the stock market going? Oh, absolutely. They can get the stock market going. They certainly have. But as you said, I've got two charts. One's the same one I think you had, basically, just sort of showing that real jump in the last week. But then the next one is, so So there's that one, and then the next one is the 5-year chart, and so that same little jump you can see is that part on the end there. So that takes us back to where we were, a few months ago, and so you are in this big downtrend. The Chinese stock market is not well owned by people within China. So if you're looking for a consumption boom, then seeing the stock market rally 15% and house prices fall by even another 0.5% does more damage to the overall Chinese economy than 0.5% fall in the housing market does more damage than a 15% rise in the stock market. So there's that part of it, but I think the real key to it, and why I'm just not completely mystified, because I do think it's a trading type thing, but I've been surprised at how much the iron ore stocks have rallied on the back of this. And the reason why is because there's no real announcements in here which is saying they're going to start building again. Like, it's all about saying, how do they stop house prices from falling? How do they help these developers finish their existing projects that have already started? And keep in mind that most of the iron ore gets done at the start. That's all the structural type stuff. That's so half finished projects might have already done 80% of the iron ore that they need. And so the part for me is saying, the market's got ahead of the announcements, particularly in iron ore, and that if you want to get back to where if you want to justify the current rise, there's going to have to be a whole string of new announcements, and possibly ones that actually start talking about reigniting the sector and getting building again. Because I still haven't seen anything out there that actually says they're going to try and get the building sector going and going to try and throw more money at this problem. It's all about how do we manage the downturn, and how do we make sure that the existing developers don't go out of business, and that the whole economy doesn't sort of implode on the back of falling house prices, as opposed to how do we blow ourselves another housing bubble. I don't know. Is that what are you seeing, Martin?
So yes, there were definitely the liquidity and the interest rate announcements. Banks holding lower ratios and cutting some rates. They've also announced some reductions in mortgage rates for the property sector. There's also some articles out there suggesting they were also helping some of the major cities with some of their building programs to try and actually rekindle some building activity, to try and actually get people to build stuff. So that, but of course, they've already got lots of spare stuff. And property prices are still way down from where they were. So I was quite surprised also with the oil, the iron ore stuff, and in fact, the BHP one, which is quite an interesting chart. Let me just put this one. BHP rocketed too, right? As you can see there, went from below 40 to up to 44. Not quite on all-time highs, but nevertheless significant up. And I was scratching my head a little bit, thinking, that's more sort of trading stuff than it is actually real, I think. I suspect we're seeing quite a lot. I also am very interested to see that the oil price didn't really react the same way. Now, if in fact China was now going to be eating a lot more oil, surely that would have put an upward leg on oil prices. It moved up slightly, but that was more perhaps to do with the Middle East. So there's something that doesn't gel for me in terms of trying to put all this together. And if you look at the total quantum, and they're talking about, it's sizable, but I'm not sure it's as revolutionary as the markets are actually suggesting.
No, and it's almost all monetary. And you're right about there's some buildings that some cities that are doing building in, but the broader it's all the second and third tier cities where most of the building was done. As a percentage, So if you get sort of Shanghai and Beijing, increase the housing again, but every other city goes back, they might increase by, even if it's like buildings up 15% in those cities, but all the second and third tier cities are falling by 5 and 10%, then it's that's net negative to the equation. And there was a little bit of talk about some handout checks for some of the poorest people, but they're not the ones going to be buying houses. You're not going to get hey, here's an extra $1,000 as a handout. You're not going to rush out and buy a house with that. And then the other part is but yes, the other part is he's been very against, Xi's been very against handouts to individuals to help fund consumption or transfers. So is this a sign that he's changed? I don't know, maybe, but it doesn't. It's going to need a hell of a lot more, I guess, to justify, I think, where I was.
And overlay that, the demographic shift, which is remarkably strong now. So in other words, the population momentum has turned dramatically thanks to 20, 30, 40 years of policy. So the forward demand for property, I can't see it necessarily bouncing significantly.
And home ownership is massive in China. It's 90% home ownership. And so you just sort of go, well, who's left to buy? There's a sort of, you're at the stage where you, at least in a, if you're talking like a market like Australia or something like that, and you're like, okay, it's 60 or 70%, okay, there's a scope we can actually meaningfully increase the home ownership. But when you're at 90% already, it's very hard to increase that. And the other thing I wanted to flash up, I've got another chart up that I thought was really interesting, is that the China 30-year bond versus Japan. And so we've spoken about the Japanification of China for a long time. And what we mean by that is exactly what Martin was talking about in terms of demographics, is saying when you have these, when your demographics have turned the wrong way and you've got these massive debt bubbles, and you decide that you're not going to do the write downs and sort of take it all in one hit, you're going to drag it out over a long period of time, is you get this long period of low rates, low deflation and just poor economic growth. And the 30-year bond rate is this expectation, I guess, markets have about where interest rates are going over a very long time, and it's sort of like the market's view about how positive or negative they look at an economy. And you can see that for the last couple of decades, the spread was extremely wide. So Japan with 30-year interest rates, and keep in mind this is 30 years of almost zero. It is a hell of a long time to have zero interest rates, but for most of it, it's sort of around 1%. And whereas China was sort of 4 or 5, and for that to sort of over just the last couple of years, and particularly over the last sort of 6 or 12 months, as we've now converged to the point where the expectation is approximately the same.
Yeah, it is fascinating. And I think that the story of Japan is an interesting parable for what may be happening in China, right? Because, of course, they had the demographic time bomb earlier. And it's interesting that Japan is now talking about lifting rates, maybe a little, but from a very, very low level, when everybody else is talking about cutting rates. So it shows you that they're zigging versus zagging. Well,
and I think it was last time I was on here, wasn't we? We were talking about the shock fall to the Japanese markets. Maybe it was 2 months ago. It seems the shock fall to Japan's markets as they were raising rates, and how that sort of they had to all turn around and say no, we're not going to keep going as far. So yes. So yes, and that's really a
just one quick comment from me, if I may. I just want to acknowledge the super chat there from Emrink, and thank you very much. Your first super chat, I believe. Thank you. Really appreciate it. It does help us to keep the shows going. And anybody else want to follow suit? Feel free. Very always appreciated. Thank you very much. Sorry, because carry on, Damien.
That's all right. Is there anything else on China, or is that it's almost a reasonable segue?
Only to say that I was interested that global markets reacted, right? So although the announcement was in China and the Chinese markets reacted, global markets reacted dramatically too. And again, I feel that was an overreaction based on what we saw, but it feels to me like the markets are really skittish. And so they're being buffeted by relatively small pieces of information and are overreacting to it. And I would argue that the Fed 50 basis point was another example of that. So we seem to be in a situation of hypersensitivity to news. Maybe that's because everyone's talking about being data dependent, but I think overreacting and overswinging as well.
Yeah, and I mean, so the US said that 50 basis points, and then talking it down. Yeah, so big hit, but then straight away sort of trying to talk it down in terms of no, don't get ahead of yourselves. We're not going to keep cutting this rate. We're going to slow it down and things like that. And so I guess the message that I got out of it anyway was that it was basically there's a 50 basis points was a catch up. It was basically, look, we thought we should have done it the time before. Then we got some information almost straight after that, which basically said, yeah, we should have done it. And so there's 50 basis points to catch up. Who knows where we're going from here? Rates will probably keep going lower, but don't expect them to another 50 basis points every meeting to the end of the year. I think was what I heard of it.
Yeah, and of course he made some comments over the last 24 hours as well, and again was saying, well, we've got plenty of time. Unemployment will probably tick up a little bit, but not dramatically. Things are looking pretty good. Inflation is beginning to come back towards band. The unemployment rate won't rise that much, and in fact, the economy is in pretty good nick. So that was his sort of. Now, the interesting question then, which comes back to the one we always touch on. Well, what is the the R star? What is the neutral rate? And there's still a massive debate amongst some analysts about where that neutral rate is and how tight the current rates are in the US. And again, we get no clue from the Fed as to what they're thinking.
Yeah, well, and I think that comes back to this liquidity conversation we're going to have a little bit later. Well, actually, maybe is that the right segue into that, or do you want to
I think that's a really good segue. But let me just throw this question in as well, because it's sort of connected, right? George is saying people are saying a 6,000 target for the S&P. Is there a correction? If there is a correction, what could it correct to? Which comes directly back then to the valuation of shares and to what extent are shares overvalued? Because if you look at the PEs at the moment, they are way over their sort of long-term averages. And so unless you think something has fundamentally changed in the markets, you've got to say the chances are we are going to see a pullback at some point.
Yeah, well, so you've got to get somewhere. You've either got to see the earnings growth actually come through that is expected. And possibly beat on the earnings side. So you can see markets go sideways and we can have earnings beats for a little bit, and that would get markets back to a more reasonable valuation. Just because they're overvalued doesn't mean they can't become more overvalued is another part. And then there's this discussion that I wanted to have just about the overall liquidity and financialization, about saying, well, maybe if you're an investor who's saying, I'm going to wait till markets get back to average valuations or lower and then I'll buy in, well, maybe they don't get there. Maybe we're in this environment where all this extra money that's come in and all this extra liquidity that's out there, and excess capital, I think is probably a better term than liquidity, is going to just drive rates lower and drive valuations higher. And so I've got a couple of charts I wanted to show to sort of back this up. One of them is this idea of just global debt. And this is a very simple measure in terms of saying, and why am I saying debt? Well, there's two sides to debt. You can't have debt without, debt's a liability. You can't have that liability without creating an asset on the other side. And so if I take a, and I'm going to pick on poor people for this a fair bit. If I take a poor person and I give them a big mortgage that they can't afford, I've actually, on the other side of that, I've created this asset that somebody now owns, which is that mortgage, and then, and that money might flow off into other different markets and sort of grow. So debt's, the creation of debt on one side creates an asset on the other, and we're in this big upward trend where this is debt to GDP. So the actual numbers are going way faster than this, but the total here, this is just IMF numbers, 100% ish back in 1950. Most of, pretty much there until 1970 before you just took off. And, now we're at sort of 250%. It does look at the end there like you go, oh, look, things are getting better though. They spiked during COVID. Now they're coming down. It's like, nah, it's just that's the problem there is GDP fell. So this is debt to GDP. The debt was rising the whole time. And all that happened was GDP took a tumble and then it bounced back. So it just made it look, but the overall trend is still very much up. And concerningly, it's everywhere. Like if you look at that private debt side and household debt in particular, which is that dark line in the middle, is gone, globally from almost nothing to significant, 50 to 70% of GDP. And then the bottom one is the non-financial corporate debt. So that's one side of it. if you take a little bit of a broader view on it, and then say, well, what about if you include stocks, bonds, cash deposits, loans, private equity, all these types of things like that? Well, now you sort of, and the ratio is different. And then actually, this is just US as well. But that's sort of gone from back in the 50s and 60s at sort of 300% ish. So assets are sort of 300% of GDP, and now we're 600. So sort of doubled. And again, you've got that blip from COVID when GDP fell, but that trend is just up in terms of the amount of assets that are floating around there. And then the final one is there's a Warren Buffett measure, which he basically just looks at the total value of corporate equities versus divided by GDP. And again, that same story. Well, again, even worse than some of the others is, the total value of equities was sort of somewhere between 0.5 and 1 back in the 60s, 70s, 80s, and now we're up near 3. And so, lots of capital around. I guess the question then is saying, well, what does this actually mean? And so we've got so I think it's relatively clear, hopefully, that we've got this around. The other addition or things that add to that is inequality. So you give a rich person an extra $1,000, they invest it. You give a poor person an extra $1,000, they're going to spend it. And we saw that in the pandemic. We saw that we gave handouts and everything like that to lots of people. Consumption took a big jump. All of a sudden, we got this inflation going. So, but we've reversed that. We're back to sort of that increasing inequality, lowering taxes, more money for the rich type thing. And then you've got the technology side of that in terms of saying, look, technology is great, but when you get sort of rapid changes in technology, and often you concentrate wealth in the hands of a few, and it's sort of, and especially some of this AI type things that can shift the power from workers across to companies. And again, that's that same part, more excess capital that's sort of floating around. So if you sort of take that as a given that there's this capital's there, and it's around, and saying, well, what does it actually mean? And so if you want to know what can you expect from the stock market? So over the longer term, valuations fluctuate. They go up and they go down. What really matters is this return on the capital that's being invested. And so the stock market tends to give you sort of 6 to 9% tends to be the range, which I think is reasonable. Having said that, it very rarely is in the range of 6 to 9%. It's usually 20 or 25, and then it's back to 0, and then it's a 30% year, and then a -5. And but that 6 to 9 over the long term is where it's sort of been. And the question is, and so if you get valuations sort of go through different cycles over like a 20, 30-year period, the valuations don't matter as much. It's more about if you can get 2% extra growth, you're going to be growing at sort of 60 or 70% more than what you would have grown at, over if you didn't have that 2% growth. So what's really important is that long-term return on capital. In the short term, it's not as important. If you get the market going from like a 10% discount to a 10% premium, like that's a 20% jump in the market valuation. And if returns are down 2%, it's like, oh, who cares? Or up 2%, it's like, that's a rounding error in the short term. But over the long term, it makes the difference. And this is the irony of this view is that if you're sort of looking at this and saying, assuming profits are constant, and we're going to come back to that, is that if you're assuming profits are or constant or growing, is that how do you get returns? Let's say there's all this extra capital and the return's going to fall, and your profits aren't going to change. Well, the only thing you've got left is the actual valuation, and it basically means you're going to pump up valuations to the level where we start getting lower returns because there's all this excess capital all chasing the same ideas. And so ironically, the odd thing is you should be buying in front of that because the excess capital pushes up the returns, and then we're stuck in this part where returns are going to be lower than average for a period of time because of all that excess capital.
Well, let me just touch on the excess capital a bit more, because I think there's a few points I want to make here. Firstly, we know that there's a lot of money sloshing around in money market funds at the moment because people are not actually necessarily convinced about the current market valuation story. So there's a lot of money looking for a home. The second is, of course, a lot of that money has come from ever high government debt, even as central banks have actually done in quantitative tightening. So if you look at the Fed's balance sheet, it's coming down relative to where it was, but governments are still printing more debt. And as you say, every time you create debt, then there's an asset on the other side of the balance sheet in some way or the other being created. And then the third question is relative returns. So if you look at bonds versus shares versus other asset classes, we've had a significant time previously when interest rates were ultra low, and therefore, the yields on bonds weren't actually very attractive. Now that's quite different, gone significantly higher, and it goes back to the R* conversation. It could be that bonds actually are going to be higher for longer into the future. So there is a quest to try and find returns by more people who have assets looking for a home for them. And obviously, if you have more people, supply demand, with assets looking for a home, and you buy stocks because you think they're going to go up or you think that's a good home, that's going to put the price up. That's the market reaction. So to what extent is this a logical market reaction to the greater liquidity that we've got floating about for the reasons we've spoken about? Or is there something changed in terms of market valuations, AI being an example possibly, which suggests that in fact the traditional price to earnings ratios are not necessarily appropriate now?
Okay, there's lots to unpack there.
Sorry.
So let me show you where the best place to start is, because there's a couple of other elements to this, and one of them was this idea that this thought that I had around if profits stay the same. So I'm going to give you an example of two different countries, and let's call one of them Destructalia, this country with sort of lots of startups, creative destruction, and what happens when you and sort of lots of competition. And so what happens when you give that country all this excess capital is they start funding these new startups. These new startups go and start competing with other existing businesses. They try and drive down margins. They push wages up because they're all trying to get the same employees. And you sort of get this transfer of wealth from sort of companies and governments sort of back into people. And you get the your margins stay low, and actually it's this drive can push economic growth, I guess, but from giving people more money. And then let's say we said, okay, that's one country that's out there that's going to take out excess capital, and we've got this other country, and let's call this Protectalia. And it's all about saying we're going to have this sort of relatively weak sort of antitrust type stuff. We're going to have lots of oligopolies. We're going to have captured regulators. We're going to have central banks that don't want anyone to go broke, and so if anything goes wrong, they sort of rush out and fire hose the whole thing with liquidity. And you say, well, what happens in this market? And then you go, well, existing companies, they get to protect their own profits. They can use regulation. They can help. They've got friendly regulators and friendly politicians. They can use regulations to stop the new competitors from coming in. Because you've got weak antitrust, they can buy, new competitors pop up that would look like they might be damaging to margins. Well, let's quickly buy them and put them, shut them down or shunt them off to a different division or whatever it is. Let's maintain the status quo. And so if you end up in one of those countries, what happens there is you get the higher valuations because the profits sort of stay in all the existing companies. And so if I invest in the stock market, so to speak, I'm getting all those companies and they get to keep their profits. And so all this excess capital, all it does is push valuations so that I'm getting lower returns. And so which country do we live in? Well, I'll let you think. I'll let you decide, Martin. I think you obviously have a lot of guests on who talk about it. And it's a the more we protect existing companies, the more we let them capture regulators, the more likely we are that they're going to keep most of the profits. And
yes, and do things like put prices up and then put them down and claim they've got a discount, and
exactly
you end up with one or two monopolies in each industry sector, so they don't have to compete very hard with each other. Now, I don't know which country we could be talking about here, but
no, that's right.
But the fact is that not all countries are actually necessarily behaving the same way. But there's still this liquidity question, and I do find it interesting, of course, that if you talk to a lot of people with money in Australia, they are not necessarily looking to invest in Australia. they actually are looking to invest in other places like the US, for example, which seems to have a more dynamic and perhaps a more destructive approach to capitalism.
It does have a more destructive, yes, I certainly agree with that. But the question is, does it have a more destructive one now than it did, say, 20 years ago or 30 years ago?
Good point.
And I think that's where I would say the regulators are more captured. And I think we went through a wave of innovation and new companies sort of popped up. Sort of 20, 25 years ago, roughly the tech boom. We saw all these new Amazons and Googles and like all the companies you look at the top of the market all came from back at that point. Are we going to see a new wave of companies coming through, like and taking away from those companies? That's the sort of key part to it. I haven't. Yeah, AI doesn't seem to be doing it yet. When the tech boom was benefiting a lot of when that was around, it benefited a lot of the telcos. All had prices go up. They were existing companies, but there was this whole wave of these new companies you just never heard of. And maybe we'll get there on the AI boom, but it doesn't seem the case just yet. Sort of outside of OpenAI, which has pretty much been co-opted anyway by Microsoft and others. So, it's that's the sort of great example of, with a strong antitrust regulator, OpenAI would have been like bad luck. You can't, Microsoft, you can't have it. And Microsoft's done a deal which is sort of not quite owning it, but has to use Microsoft servers and all this other stuff like that. And there's the whole back and forth deal they've done in a way is making sure that is to get around the anti-regulation is they probably wouldn't have been allowed to buy it, but they've done enough to to make it close enough that they don't have to. And so so I think there's I think that sort of says to you that the valuations will get higher in my view. I think there's another couple of other ones that we were talking about there. I mean, the whole idea, the inequality side makes a difference. So look, does Kamala really want to raise corporate taxes? Maybe she does, maybe she doesn't. I don't know. It sort of feels like the type of promise to me that's like, if I get into power but I don't get both houses, and then I try, certainly I'll try and put it through. But if it gets knocked back, it's like, oh well, I tried. Doesn't seem to be like a core principle.
There's a difference between positioning for an election and actually what you do if you do get elected, right?
Yeah.
And I think that's a very important thing to bear in mind. So a lot of the stuff that's being spoken about on both sides, I would say, in the US, is about positioning ahead of the election rather than actually what they might do. And they're both policy light, actually.
Yes.
So you don't actually know what they're going to do.
No, and I think it's pretty safe to say, though, you'll get more tax cuts from Trump, in whatever format they come through. Yeah, well, that'll happen.
For some people, perhaps the top end of the market rather than...
Exactly. You're probably more likely to increase the inequality. Exactly. Yeah, and it'll be corporate tax cuts.
Yes.
And so, I think there's certainly that side of it. But look, maybe that's, maybe that makes a bit of difference. It's an interesting one on the bonds you're talking about. So the issue with bonds then comes back to saying, are we in this structurally higher inflation market? And as I said, lots of debate about it. What's the right long-term interest rate? I don't know what the answer is, but I know what the questions need to ask, and I know I know what I'm looking for to try and work out whether we're going to get there. And for me, the key part for me is when the pandemic hit, we threw a lot of money at people who weren't working. And so, and they wanted to go out and buy stuff. And sure, that pushed up inflation because a lot of them weren't working. So there was part of that. But the other part of that was, hey, fiscal policy works. We've had 20 or 30 years of like not actually getting out and using fiscal policy because it's all like, oh no, it's got to be monetary policy. Monetary policy is the only thing that works. And so the question now is, are politicians going to be emboldened, and this is a new way of doing things, and so any sign of problem, so let's say we go into a bit of a recession in the next year or so, and we see some maybe there's some commercial property losses or some more bankruptcy sort of increase and all that. Do we then see these large stimulus projects and all about getting money directly into the hands of consumers. Because if we do, then yes, that's structural inflation. Inflation will be structurally higher. If we're building fiscal policy back into our toolkit, and fiscal policy that's targeted very much towards giving lower income people, more safety nets and things like that. If, however, what we learnt from the pandemic was inflation sucks, we can never have inflation again, we shouldn't spend money, we shouldn't go out and rush out and do that and do cash splashes everywhere, which some politicians seem to be learning those lessons, then we're back into where we were for most of the 2000s, or till 2010s and onwards, which is just this grinding lower of more inequality, more lower tax rates. We can't get inflation going because we haven't got because there's not enough demand from the lower income workers, and so we're trying to get demand by asking them to take on more debt. We're sort of basically trying to fake it by saying, which I think is what we basically did for most of the 2010s, was we're not going to pay you enough, but how about we lower interest rates so you can borrow more money, and that'll make you feel better. So yes, you're still living in a house, but you just can't, rather than being able to buy it now, we're just giving you a mortgage that lasting for a lot longer. And I genuinely think that's, I'm not sure which way we're going, but that one seems more likely to me at the moment. I might be wrong, and it might be that politicians will come out with cash splashes and all this type of stuff at the slightest hint of danger. But take Australia and Kate, we're running budget surpluses. So,
well, we are. But if you look at the latest announcement, which was this week, right? Some of that was a bit artificial because they sort of moved some spending into the next financial year, and both revenue and costs were a little lower. And they've still got a structural deficit. So if you look in the forward years,
and commodity prices as well.
Exactly.
Probably. No, you're right. It's probably I'm probably using the headline figure rather than the underlying for that one.
I would argue that in fact Chalmers and co are actually supporting the economy quite significantly at the moment. Right, greatest proportion of jobs growth in the public sector. Example one.
Yes.
The fact that the spending has been manipulated to kick it out into next year to an extent. The electricity support, for example, which of course is one reason why the interest rate probably will stay higher for longer in Australia, according to Michelle Bullock, because we've got to look through that because it's not real. Right.
Well, unless they go and doing it themselves. Yeah, that's right. So that was the Labor Party creating the problem and then solving it.
Exactly, and of course, bearing in mind the timing of the next election, this is all quite significant. But I guess where I was coming from in my thinking was, I would argue that the reason we got the inflationary kick that we did was because of this massive liquidity surge that was created through central banks taking interest rates down to close to zero, all the government handouts and support. If you look at the money supply has in many countries got a massive kick up. So therefore, people had way more capacity to spend relative to what they had previously. I'm not surprised then that inflation started to run away. So in a way, the question I've got is, if you continue this liquidity flow that you've got, are you not laying the foundation there for higher inflation for longer, which means that it's unlikely interest rates can come back down? Yeah.
So the question, and I don't. This may just be the exception, but I'll just say, well, Japan ran interest rates of zero and flooded the market with government debt and tried to get people to borrow. And yes, there were demographic issues and things like that, but they've been struggling for whatever it is, 20, 30 years to actually get inflation going in that market. And so some of that will be demographics, but I do think a big part of that is that monetary policy just doesn't work well once you get past a certain phase. It's very good at stopping things from overheating, and it's very good at when things have been overheating, is giving that sort of burst of extra support to people and get people to gear up. But its trick on the downside is, hey, Martin, how would you like to take out a bigger loan? And by you taking out a bigger loan, you've now spent more money on tradies and all these other things. And so that's helped juice the economy. and that only works to you run out of when you can do that, or you end up like the European Union did with effectively negative interest rates, where they're funding the banks. You're funding the banks to go out and lend to people so for me, look, monetary policy absolutely works at a certain level. But I do think at that lower bound where we got stuck for the last decade, for the whole 2010s, it showed that monetary policy doesn't work if it's not supported by the fiscal policy, and particularly in terms of redistribution of to away from people who are just going to invest the money and back to people who are just going to who will spend the money. Now, whether that's right morally and all those, we're not going to the moral ones. I'm just saying that it's a I think there's the less. I think to me the pandemic showed that the targeted fiscal really does make a huge difference at that point in terms of getting demand actually genuinely going. And so, what did politicians learn from it? I don't know. Did they learn that we shouldn't do this, or did they learn that we should do it? And I think the answer, there's certainly people out there who I read on a regular basis who are saying no, they've learned the lesson that as soon as you run into problems, throw money at the problem, and that means inflation is going to be structurally higher. But I do think there's another element out there, which is, well, that I was in power and I got kicked out because inflation was too high.
Yeah.
And so, maybe they've learned the opposite lesson. Who knows?
And I think there's an interesting dichotomy between doing what's right politically speaking and doing what's right economically speaking, right? And sometimes those two things pull in rather different directions.
Absolutely.
The high migration, the gas cartel story, all those things, right? So there are some reasonably strong structural issues in Australia as to why we are where we are. And those are politically, third rails. You don't want to touch them. Although negative gearing was probably one of those, although somebody's just gone and touched it the other day.
That's a weird, that seemed a weird trial balloon to float. I know. Yeah, I thought we're never going to touch that again, to be honest. That was, not to say I don't think house prices should be lower, but I just don't know. I honestly don't know how you get there, because it seems, well, actually, sorry, I'll tell you my theory of what we should do to get there is I think if you start telling anyone that, hey, I'm going to go through with policies that might bring the value of your house down, I don't think you're ever going to get voted into to government. I do think the government could really focus on rents. Would be my suggestion, in terms of saying maybe I think there's a less of a political concern if rents are going down, or matched to whatever it is, aged incomes and things like that. And so, that's your. I think to me that's your best hope, is that they target trying to get rents down, and by targeting trying to get rents down, house prices actually do eventually come down. And anyway.
Well, of course, if you do that, then investors will say, well, it's not worth me investing now, so therefore I'm not going to actually hold this investment property. And then the question is, well, do they sell that property, and who they sell it to? I mean, this is
exactly.
This is a huge multi-dimensional Rubik cube problem, right? If you want to solve housing, and you have to go back to the 2000s when they basically brought in negative gearing, CGT, the deregulation of the financial system, Aussie John doing his securitized mortgages and everything else. All of those things were part of it, and then they lowered interest rates dramatically through the next little while, increased the ability to borrow more, which then led to the debt bomb ticking higher, which put home prices higher. So all of those things. Then you overlay high migration on the top to create more demand for property. So you've got huge demand. And then what you do is you actually break the building sector by giving them home builder, and then wrecking it later. And then of course
increasing energy prices so that all the building material prices skyrocket.
Yeah. That's right, as well as all the imported stuff is now a lot more expensive. So you can see, if you look backwards, you can see how we got into this horrendous cul-de-sac that we got ourselves into. But I agree, there's not a simple way out from this point, and simply saying, it's a supply
there is a simple
issue.
way. There's not a politically simple way.
No, exactly right.
The simple way is you just roll back all this stuff. But nobody wants to lose value on their house.
So you have the Greens who say, no, high migration is great. We don't worry about that, right? We've got
and if rents are too high, we'll just cap them. Let's just cap rents so they don't go up. Yeah.
Other people saying, we just want to build more, so we build a lot of high-rise stuff out in the west of Sydney and other places where nobody wants to live, but it'll be a bit cheaper out there. So this is a huge complex issue. Now, the reason I'm dwelling on this slightly is because one of the big sectors in Australia, of course, is the banks, and CBA, of course, has been significantly lifted in recent times. Come back a little bit now. And it's interesting that when you actually watch the banks and what they're doing, and particularly on the mortgage books, they're actually now getting quite aggressive in terms of trying to actually gain share in the mortgage market again. So once again, we are seeing now a lot of pressure coming in on lending standards and, arguing that APRA should release the brakes. And in fact, the Conservative Party has now come up and said, well, maybe what we should do is to actually have more intervention into APRA's lending standards. So once again, what you see is the political going right all the way across what you might think is sensible from an economics perspective.
Absolutely, and I think must be. I don't know, how long ago was it we were discussing APRA and Wayne Byers, and that was it was definitely a government ago, but the whole political influence in that part and captured regulators and
yes.
And, are they there to regulate, or are they there to try and help the government of the day push through its economic, plans? Well, and I think we have a number of issues in terms of those, and that's just one more problem I think that we've got in terms of saying, are we running these? Ideally, these things are meant to be there to prevent systematic problems, and then but when you have politicians starting to say, well, maybe we'd save a bit of money by not having fire insurance, or whatever it is. Maybe we can cut a few corners. We can save a bit of money by doing whatever. And it's like, no, let's not put safety switches on because they're going to cost all this money. No. I know they cost money. They're meant to cost money. That's the idea. Is you've got the safety switches on, or you're paying for the insurance because if something goes wrong, you need it. And so, but if you need a housing boom, then you need a housing boom when it's run out of legs, and you want to find one more leg to it. Then yes.
Well, there were headlines this week saying the RBA was indicating that if rates were to go lower, that could put another rocket under house prices again. And of course that got a lot of reporting in the media as well. So yeah, I've said for quite some time, there is a scenario where house prices continue to go higher because nothing has fundamentally changed.
Yeah. But Commonwealth Bank, to be priced at sort of similar, I mean, it's not quite the same as all these tech stocks, but actually if you make some adjustments to some of the tech stocks earnings, it actually comes out, let's say you adjusted Meta and got rid of the spend on virtual reality.
Yeah.
Just said, let's just say they shut that division down and they did the rest of it. You get a valuation roughly the same as CBA. You're saying, is CBA tech stock? Is it an AI?
I actually saw one chart that did some of that adjustment, and they had Nvidia at the top, and then they had CBA, and then Amazon below it.
Right.
which tells you something. I'm thinking, hang on a moment, what is this stock, right? And
yes.
I mean, the other bank's not doing too bad either. But going back then to sort of the broader question where we came into this, right? So we have this liquidity issue. We have a lot of money floating around internationally, and if you look at the euro dollar and all those sorts of things too. So there's a lot of hot money there. And is that one of the reasons why we've got this high volatility environment that we're in, and why we see markets going, up and then down and all over the place? Is it really the liquidity that's creating the problem?
There's certainly a short-term issue around. I like to characterize the market as having sort of three big players in it. And for a change, I'll start at the one end, which is high net worth investors who basically don't really care as much about whether they're in the market or not in the market. Um, and and so, if markets are high, they'll just sit in cash or private equity, or they'll buy businesses or do whatever. And then when markets get cheap, they'll sort of flood into the market. So they're the sort of people, and if they miss a 30% rise in the stock market because they happen to be sitting in cash, then they don't feel good about it, but there's no one firing them because it's their money. And so that's sort of the sort of your swing factor in terms of that extra real long-term money. Then you've got this sort of middle section of the market, which is people like myself who've been given money to invest. It's like, yes, here, I've given you money. It's your job to go invest it. Go and find the best value out of stocks or bonds or cash or international, or whatever it is that's going to, your asset allocators trying to say, okay, I've got money. What's the best asset I can put that money into at the time? And so we'll help balance markets by saying, the first category helps balance the overall. Is markets really expensive or are they cheap? Then we're sitting in this middle is people like myself, and we're sort of about saying, well, let's get the balance between bonds and equities right. And so when one market gets too hot, and it's sort of about saying, oh, let's take money out of that and put it into other markets. And we work on sort of a probably more on a monthly or quarterly basis, I suppose, rather than a daily basis. And the longer term investors are probably more like on a yearly basis. Then you have the short-term players, and they're the guys who you're traders and hedge funds, which probably can operate across all three, but they're more talking about minutes or days or in terms of their timing, and they're sort of often, okay, here's a trend that's happening. We're going to rush into that trend, and we're going to be all on one side of it, and then when it unravels, actually, it's going to fly back the other way because they're all using very similar momentum models and very similar, the models they use, because they're so similar, they work really well until they don't, and then it's about saying I've got to beat the rest of the herd. It's you're running around from one sort of fire to the next fire, or one sort of thing to the next, and you just need to make sure you're not going to get trampled by everyone else. And I think China's a great example of that, where it was very, very shorted by hedge funds. Then all of a sudden this extra stimulus, and so all that short-term money goes, flip from negative to all of a sudden we get the asset allocators start to move some money, and maybe some long-term people start to move some money in with these Chinese announcements, and then all the short-term one rushes the other side, and so pushes the market much, much higher. And so I think that area of the market is bigger than it's been in the past, and that is contributing to this volatility. And so, and so that's sort of like it's a bit of, and we saw the same thing with the Japanese market, where Japanese bonds, all of a sudden, the carry trade's over. Right, there's this flood of money, and maybe it's not even a flood. It's just that the longer term and the middle term is moving money around a little bit, and the short term guys are rushing, trying to get in front of them, and trying to sort of push it sort of too far. And so I do think that's making a difference to the volatility, but probably not as much as it's probably not more than 50%. It's bigger than it's been in the past, but I don't think it's the primary factor. I do think one of the primary factors at the moment is just the pure uncertainty. I think there are so many things that are unclear, and we've been in this bull market for a while. We're getting valuations are really high. There's people out there with cogent arguments that, hey, it's all finished and it's all going to roll over and we're into recession, and that's the end of it. There's other people with very cogent arguments, which is actually there's this AI boom going. We're in the early stages of it. Markets are probably going to go overshoot on the upside. There's actually a fair bit more to run, and so there's this push pull between it. And then on the interest rate sides is the same. We've got people in Australia saying, hey, maybe we need to raise rates a little bit more or keep them steady for a lot longer. And there's others saying, no, we need to cut right now. Like it's a great deal of uncertainty, and bits of data are like tipping more people each way. And I think that's where most of the volatility at the moment is coming, and that's usually where you see lots of volatility is around sort of these inflection points where you get lots of debate. Are we going into recession? Aren't we going into recession? Are we going to cut interest rates? We're going to raise interest rates, that type of environments.
Mm. And I want to make another point here. Of course, there are lots of talking heads on various outlets or from the financial sector, in the advisory sector and what have you, right? And I always remind people that a lot of them will be spinning a yarn, but they've already taken their own positions. They will already be on the other side of the trade potentially. And sometimes I always think that if they say zig, you should zag, because it means that they've already zigged.
Yes, and commodities are a great example of this. Commodities are ground zero for this. Is that you see in the last couple of years we've been through 2 copper booms and busts, not massive ones, but big enough. And always at the top of it is when they're the most strident. All these analysts, you'll see them out on all the different financial news saying, green revolution, boom, buy copper, all this stuff about buy. That's the only thing that's going to protect you from inflation. And that's because they've already got all their good clients into it, 3 months earlier. Now they're trying to get their clients out, and they need somebody else to buy. And so it's like, well, yeah, I'll talk on news. I didn't say a word when I was telling all my other clients, telling the people who are paying for my research, I was telling them, yes, get in, and I was getting them into that trade and all that type of stuff. I'm playing as quiet as I can because I need to get in, big amounts of money. Now we need to get the money out. I'm on financial press telling everyone, hey, you got to buy this, buy what I already bought. And, because I need somebody to take the other side of it while all my clients sell out. So yes, I think there's everyone's got their own vested interests in these things, and myself included. Like everything I'm telling you, I'm not telling you because I'm about to do these trades. I've already done these trades myself. I'm telling you how my portfolio is positioned. Unfortunately, it's I'm in the world of global macro, and global macro sort of trillions of dollars in size, and we're not big enough to make a difference in terms of those. But it's absolutely everyone you hear from in the financial markets has got some sort of conflict, whether they will be upfront about what it is and admit it, or whether they'll try and trick you into it. But yeah, everyone's got a conflict of sorts, and nobody's out here saying, yes, I've discovered the secret and I'm just going to give it to everyone, free of charge.
I always think if they had the secret, they wouldn't be on talking on TV, right? They'd be on a yacht,
or trying to flog it to you for $50 a month or whatever that price they want to. Yeah, that's right. We've discovered the secret to stock markets, and you can have it for just $49.99.
Exactly.
Yes.
Yeah, I could say the same about some property people. I won't go there. Now, one of the things I wanted to touch on just before we get on to the next item is just on gold. It's worth just putting up the gold number here. I think this is the story of gold, right? Because you can see there that it was at 1,800 back in 2013, and then it dropped down to 1,200. It's now at 2,671, a little bit of its highs, but significantly higher. And there's a bit of discussion about what it is that's driving it. And of course, we know that, for example, China and some other central banks have been buying gold big. We also know that gold tends to be a bit of a hedge in uncertain times. And I would argue that the uncertainty we've been talking about and the price of gold is probably connected. But what's your take on what's going on? And is this a significant move, or is this a temporary, or
Yeah, I think I read a number of gold people, and they sort of vary in there's the true believers who are like, you're worried about deflation, buy gold. You're worried about inflation, buy gold. You're worried about somewhere in between, buy gold. There's some people there's a story, whatever the story is, they can sort of always tilt it. And so I do try to avoid those ones. But the people who are a bit more, they're usually concerned about, volatility or markets breaking down. They're the ones who do tend to sort of be more, I guess, give you both sides of the story. And most of those are quite confused about the rise. And I think for me, that's it's certainly risen further and faster. And most of them are, think gold should be higher, but it's risen further and faster than expected. And for me, I think it is a central bank and emerging market issue around the US, appropriated all the Russian assets, or at least froze them, and Europe did. And so if you're Russia or China or anyone who's thinks that they might be the target of sanctions in the US, then you've got a built-in incentive to do something else to avoid being all in. You can't avoid the US completely, but if you can put more at the margin into gold, then you will. And I think that's the effect. It's hard to put my finger exactly on what else is sort of driving it. But beyond the other factors I spoke about, gold's that interesting one insofar as it's not a meaningless it's not a meaningless asset, but because it does genuinely get used in an industrial sense for things and for jewelry and other things like that, where it's great metal, but the amount of money that gets spent on investment and central banks or governments just overwhelms the amount that gold gets used for in anything else. And so really it's about trying to work out, well, if I can work out what other investors are doing and what central banks are going to do and just get in front of that. So if I think they're going to be getting out, I need to be getting out. And if I think they're buying more of it, then I should be in front of it. And so it's the greater fool argument. I know I'm going to have to find somebody else to sell this to. So I just want to make sure I'm in front, trying to lead the pack. So yeah, we've got a bit of gold in our portfolio. We've sort of been winding it back a little bit as markets have been rising, but I haven't got any great and different insights, I suppose, into the gold other than.
Yeah. So I agree with you that part of this is the uncertainty that's out there. I think also particularly China and Russia and some of the things there. If you look at the assets now and 20 years ago, you could have actually increased your assets more than gold over that period of time, right? But I suppose if you believe that the market's going to turn to water, then you might argue that there's some reason for it. But I actually think that this is not necessarily a totally logical positioning at the moment. But
some of it's the liquidity stuff we spoke about before. Money's there; it's got to flow somewhere.
Yeah, spot on. I was going to say exactly that. So to me, it comes back to the liquidity discussion we had earlier on, and then the uncertainty question, and uncertainty and liquidity together, you get this sort of result. Interestingly, crypto hasn't done quite as well, although it depends on where you measure the base point from. But certainly over the last few months, it's gone a little bit up, a little bit down, a little bit up, and we'll see where that goes. Now, as we come towards the end of the show, there's one other topic I want to explore with you, and this is the AI strawberry story, because this, I think, don't know what you think, but I think this is a really big deal.
Yeah, this is. Yeah, I think so as well. And well, sorry, I suspect it might be. I think with all of these, we've got to remember AI hasn't been around for, well, sorry, certainly in a broad sense, these AI large language models really haven't been around for very long. And we're taking these very short time frames and trying to extrapolate out, years and decades. And so, but it is important in terms of trying to track back what's happening. And so I think the thing to remember on the AI front, I just want to sort of take one step back to sort of paint the big picture, and then I wanted to get into the what's different about Strawberry that might be changing business models for a whole bunch of companies. So effectively, the more data and the you can throw at these things, and the more parameters you can have in your model, the better the results. And so both of those, bigger and bigger, you need more computing power. And there's some interesting charts that are out. I might just show up if I can on these scaling laws about saying, there's this theoretical line that we're sort of not crossing. This line, and basically it's going. The two charts on the right are basically saying the more data. On the y-axis, this is the losses. So what do we think we can? What are the errors that are being made that we think we can improve on? And then how big is the data set and how many parameters? That's the two charts on the right. And it's these are log graphs, but it's pretty much a straight line of like, what the more data we get, the better the answers. The more parameters we get, the better the answers. And effectively, to get the two of them together, you need this compute power to actually get there. And you can see that sort of that compute and the errors as they come down, it sort of seems to be hitting this line, and consistently so. and sort of, and then if we jump to saying, well, let's have a look at a bunch of different problems it's trying to solve, and you go, well, images seems to have that same type of line. Text to image seems to have that same type of line. Video seems to have that same type of line. Language seems to it seems to be this exponential. Just the more we can throw at this thing, the better it gets. And so, what does that mean? Well, actually, it seems to mean at the moment, because it's not edging off, is that we just need more computing power. And over that sort of 1990 to 2000, I've got a chart up to sort of showing the blue lines down the bottom is CPU improvements. And again, this is on a log scale within individual chips. And then we can see how that sort of tailed off into the 2010s. But GPUs, which is the graphics processing unit, that sort of started on this 45-degree line as well. And so that's one part of it. And then you're adding onto that, getting GPUs to talk better to each other and GPUs to talk better to other parts of it. And that sort of gives us this real exponential growth in computing power. So I guess we're at the phase now where the models need more data, more parameters, more computing power. The computing power is sort of coming through. And what's really interesting is, and this is just diagrammatic, this is not, it's not exact, but it's sort of showing a rough spread of what the prior language models were doing. And there's sort of this pre-training, post-training, and then inference. And the pre-training is the gray lines on this. And so what you can see is that if you're spending money on a language model before this, you would spend 60 or 70% of your money on the pre-training. Then you spend whatever it is, 20 or 30% on your post-training. And there's a very small slice on the end was the inference, which is actually people actually using your model. And so if you think about it in a sort of I like to term it in a regression sense. I spent a long time trying to come up with this model that said y is equal to 2x plus 5. And that was my pre-training. And I've got my it's obviously not that simple, but that's my simple model. And then the post-training is like, oh, actually, you know what? If I made it 2.3x plus 4.5, it actually is a better model, and I do that by seeing what I'm getting wrong and trying to, do some other things to get it right. But the actual part of people typing, X into my formula and coming up with what they think Y should be is a very simple calculation, and it's being done really quickly. So that's the old model. Strawberry, which is this new large language one that's come out, it's very different. Now you're spending 25 or 30% of your money on the inference part. And so what does that mean? Well, a whole bunch of things. One is it might be that we don't need the same type of computers to do it. So it does seem that GPU is very good at the pre-training and very good at the post-training. It's not as good at the inference. It's still good at the inference, but not as good. And so maybe there's these other, there's a couple of other types of models out there that, or a couple of other types of software out there that could be used that might actually start taking market share away from these guys. That's one part. The second thing is, well, and actually I should before I even mention this, like this is just one model and it's only just in beta and only just getting out there. Maybe this is just temporary. Like maybe this is just like we'll go back to the old model and throw away all this analysis. But the thing is, with these new ones, they're going to cost a lot of money to actually do the search. And so it's turning it less from a software company, which is I spend a lot of money building my software and then it's almost free to distribute it. And I just want as many people as possible to actually, it's a bit more of a service model now. I'm sort of spending money building my model, but now I need to charge people to every time they're doing queries to bring it back. And so then it sort of leads to that question about, well, do people want the answers to be right, to be approximately right and free, or do they want it to be really right and cost a lot of money? And then you get to the part, well, if it's a driverless car, where you probably want it to be really right, or if it's an engineering project. But if it's a social media or it's a marketing plan or something, I don't know, something a bit different, where there's not really necessarily a right answer. Maybe free and almost right's right, or maybe it's just a matter of time. And so, I think there's certainly issues there. I do think it makes a difference to the mobile technology front as well. Apple sort of came out with a few announcements just saying about how, you're going to get the new phones, AI and all this type of stuff like that. I was always a bit skeptical that you'd be doing much calculation on your actual phone. And it always made more sense to me that it would be treated a bit more like search. That you're basically sending off to a server somewhere that's doing the calculation or grabbing whatever it needs and firing it back. I think this model just makes that even more certain. I think that you won't be doing it on your phone because it won't have the right technology on your phone, or you need that changing technology. It's going to be more about you're going to have more specialized equipment on a server somewhere. And so, so I do think it makes a difference to the mobile technology one. I think there's a business model side to it. I think if you've got a software type provider and you're more likely to end up with only a couple, the original model, you're more likely to end up only with a couple of big players in it because there's this big spend to get you up to it. And then you got to keep up with it. You got to keep up your thing. And it doesn't cost you very much to get consumers. So they're incentivized to keep the prices really low and just get as many people, so it's OpenAI giving it away for free and then charging, for the next models. Like that makes a lot of sense. And a lot of people are aggregating to just one or two. Whereas if there's going to be a huge cost to run these things, maybe it makes more sense for, I don't know, people like Apple or Meta or people like that to say, well, rather than using somebody else's, I'm going to be spending, hundreds of millions of dollars a year anyway running it. I may as well develop my own, or I may as well have my own sort of, or we'll get a consortium of people together and create competitors or something like that. So I do think there's a more dispersed model you get. What else was there on this? But yeah, it's all really early days, but it could be a dramatically different business model for it, and it could make a huge difference for NVIDIA. Depending upon, there's a couple of different inference ones out there that could crop up and take market share. But yeah.
And that would suggest that it isn't just the GPU that's the critical bit, right? It's actually it's the post-stream part of it, right? Which is actually where the value really is, actually.
Yeah, well, and these are sort of models upon models as well. So it's sort of this, and it's not necessarily true that NVIDIA's going to get replaced, but they might. I suppose it's sort of saying that GPUs at the moment, if you got to pick one, and if you had a budget of whatever it was, $50 million you're going to spend on this today, you'd probably be spending in the high 40s on GPUs because you're like, I know these are going to work. They might not be the best, but I know they're going to work. I might throw a few million at some of these other ones and hope that one of these comes up with a much cheaper, better, whatever it is, solution. But most of my budget is going into the thing that I know works, and it might be that there's a few tweaks, that NVIDIA or these guys make and then improves it again, or they might be the one that comes up with a better inference chip. So I don't want to sort of write them off on that sense. And as well, there's the market size is still pretty big on all this, but I just want to highlight that there's stuff going on, and keep an eye on it because it's. And we're taking very, very short time frames and trying to extrapolate them out for long periods of time. And so you're going to get wild, and that's this uncertainty part. You get wild swings around in those.
So, if we stand back a little bit, uncertainty in the whole AI realm, for the reasons we've been talking about, uncertainty in terms of the election in the US, uncertainty with what China's doing, uncertainty with where inflation's headed and what the R-star is, and all of those things. So when you're thinking about a portfolio and portfolio construction,
yes,
help. What do you do?
Yeah, diversification. Yes, I think, and we're probably in the same boat as a lot of people in the sense that, look, we've got a fair bit of equities. And so the rally's been good in terms of that sense. We would like to have some more, and sort of hoping the markets pull back a bit so we can buy some more, but hasn't really done it. So yeah, it's hard to it's a hard market to be out of. We're certainly sort of not. We're deciding we don't want to be out of it. We'd like to be involved. There are some things that could turn negative, but we think we've got enough time frame to start selling out and to see more signs before we do. So my bigger concern is that we do go into an AI capex boom. Interest rates are falling down, but the economies are weak, but not falling apart, and that's enough to see valuations stay high, and potentially even go higher.
Right. And one other little question, which I'll bowl at you, is the Aussie dollar, right? Because in fact, if you look at the Aussie dollar, we are now at 69.
The rocket.
Right.
Yes.
Whereas we were, 60, 64, we got down to 63 and a bit at one stage. It's quite a big move. Does that influence your decisions in terms of portfolio construction?
It absolutely does. The higher the Aussie dollar gets, the less Aussie equities I want. The higher the Aussie dollar gets, the more likely I am to be moving money into US dollar cash, or just foreign currency cash more generally. Where can I be wrong? Because that's, I think with any investment, you're like, okay, I know what I want to do, but what am I watching to see if I'm wrong? And the things I'm really watching to see if I'm wrong is what we spoke about at the outset. It's the China. If this is just the start of like an inexorable, the announcements at the moment aren't enough, but that is going to keep coming and keep coming and keep coming and keep coming until eventually they are, then iron ore price is higher, and we reignite a building boom in China, then iron ore price is higher, and an Aussie dollar should be higher. If it's the other way, then that's where I think I'm right. Is that I do think that China hasn't announced anything yet that actually says there's a structural change, and I think the iron ore market has run way ahead of what the announcements have been. And as you said, oil hasn't really moved. Most industrial commodities have moved a bit, but nowhere near what iron ore's done. And so, I think that's a more impetus for me to be moving out of Australia.
Yeah, Jason, thanks for the super chat too. Really appreciate that. And the fact that I want to sort of end on, Damien, is, and the reason why we talk about some of these international angles is because if you're thinking about a portfolio, even if it's a portfolio based in Australia, you need to take some account of what China is doing and what the US is doing, because the macro, the international, have a huge impact on what happens locally. And therefore, you can't just sort of say, oh, I don't care about what's happening out there. You need to understand, because it influences even local decisions.
Yeah, that's right. And look, 30 years ago, if you're talking about portfolios and what people should own, it was they'd tell you should be owning 90% of Aussie stocks or whatever. Of your stock portfolio, most of it was Australian. Very little of it was international. And as time's gone on, more and more is becoming international, and that's for a couple of reasons. One is people were just selling what they could. There's one thing to see. Maybe 30 years ago, even if you had the view that, hey, you should own lots of international stocks, chances are whatever company you're working for didn't actually have access to them, and it was very hard. And so it's like, well, no sense in telling people to have that if I can't sell it to them anyway. And so some of it's the ease, and for example, we find it's actually far cheaper for us to trade US stocks than what it is to trade Aussie stocks. So there's so some of it's ease of access, but then there's this part about the Aussie dollar acts as this really good shock absorber for Australian investors. So when markets run up and you have quite good international markets, quite often that's because the world economy is looking better. And so the Aussie dollar rises at the same time, and it takes a little bit off the top of what you might have earned on it. But what it does mean is when you run into trouble and you see markets fall, so we spoke about the Japanese market being down 20-something% at one point, but in Aussie dollar terms, it was sort of down 5% because the Aussie dollar and yen had moved the opposite way. And so, there's just been this sorry, so that's one is it's actually the risk return for Australians is actually pretty good because the Aussie dollar works as a shock absorber. And then you just go through what do you spend your money on? If you want to go on international trips, well, you're going to need something in a foreign currency. Chances are you're not buying an Australian car because we don't make them in Australia anymore. Your phone's made overseas. Most of your entertainment's made overseas. You go through all the bits that how many things are imported, and there's quite a lot. And so if you're thinking just about that whole, I want my investments to help fund my lifestyle in the future, and particularly if I'm not working, and saying, well, you need foreign currency if that's the case, because a lot of these things are going to be priced in foreign currency. And so, the benchmarks now is at least 50-50 Aussie versus international, and a lot are starting to stretch even further to more international than Aussie is, just as a default position. Yeah, I mean we've got that ourselves at the moment as a sort of tactical move, because we want more international than Aussie, but yeah, it is starting to creep in as a default. That you shouldn't be just looking at Australia; you should be taking in international as well.
And in fact, if you look at a lot of superannuation funds, where people are actually putting in money at the moment, they'll often be quite diversified, and you might be given a choice, you might not be given a choice. But I'm interested to see more and more people now more exposed to the global economy rather than the Australian economy.
Yeah, absolutely. We've got plenty of people who, within our super funds or within our just normal investment funds, will choose just not to have any stocks, Aussie stocks at all. And that might just be because they've already got them themselves, and they're like, okay, I'm already managing my other ones. Can you guys just manage the ones that aren't that way? But there's also, I'm always encouraging of people, like we sort of run our portfolios in relatively large portfolios, but with the idea that you can sort of cut things out or add things in with the view that, look for, say you're working for an Aussie bank, maybe you don't want any banks at all in your portfolio. You've got enough personal exposure to banks from your job and, probably your house and, the whole Australian economy and things like that, is saying, well, I don't need more in my investment portfolio as well. And that's the same way we encourage people to look at, their everything, look at your whole assets, and then you can sort of use our portfolios to cut things in or add things, cut things out or add things in that you might not be getting elsewhere. And so that sort of it dovetails with other things you're doing.
Yeah, well, the whole idea of being able to mix and match and tweak and control, that's remarkable in terms of the capability that you have there. One of the reasons why I keep reminding people of the flexibility and agility of what you offer. So that's one of the reasons why I have these conversations.
Well,
right?
And actually, I should have done I missed my chance on the gold to say, so the gold's a great example where you go, you want extra gold in the portfolio. Do you want hedged Aussie dollar? Do you want unhedged Aussie dollar? Do you want just a basket of global gold stocks? And so that's just, you just tick the box and choose what you want, and it adds it to your portfolio. So even if I'm relatively, I guess, I might have a different view. I might be less bullish than you on the gold price, but if you've got a view that you'd love to have 10% of your portfolio in gold, and in whatever one of those different categories you want, you just choose the boxes and you have 10%, and we'll manage the rest.
Well, Damien, thank you very much for sharing your thoughts again. Always very interesting to see what you've been thinking about, and you always bring such insight to these conversations. And links and things below if people want to find out more about the What the World Funds and Nucleus Wealth. It's all there and available. And I'll look forward to picking up the conversation in a month's time when, well, we'll be, just before the US election, and we'll have had October and into November, and, well, who knows what's going to happen then. We certainly live in interesting times.
Yeah, absolutely. It's, there's certainly been a lot of people calling for some weakness prior to the election. So it'll be very interesting to see whether we get any of that over the next month. And then the other thing is, the market does seem to be in fast forward. Everything seems to be coming early. Maybe by November we'll be having our Santa rally already.
Then it'll be Christmas. What a thought. Yes. Damien, thank you very much. I'll look forward to the next time, and I'll take you offline and close the show. See you later. Cheers.
Thanks. See ya.
So there you go, folks. I hope you enjoyed that. Very interesting insights from Damien, as always, and very, very significant moves there, and a level of uncertainty, which is what I've been reflecting in some of my recent posts too. Just to say that next week I'll be on and I'll be talking about the latest from my modeling and financial stress, etc. There's so much going on in that analysis at the moment that I felt it was important to do a live show about it. So that'll be the show next week. And the week after, I think I've got Robbie Barwick coming on, so make a note of that as well. Anyway, before I go, let's look at the dogs. The dogs are still there, still sound asleep, so they've been quite quiet, which is good. So they need another walk now. That'll be my next task. And so I better close the show and get on with my day. Thank you very much for spending some time with us this evening. Take care, and we look forward to seeing you on the next show. And of course, we release recorded shows every day of the week. This is Martin North from Digital Finance Analytics, signing off. We'll see you next time. Take care.